The S&P 500 index fund has been advertised as the safest investment to get the best year-over-year returns, and generally speaking, it has been when looking at the past historical data. Millions of Americans have their life savings tied up in it, and many retirement accounts invest in it. I mean, it has the 500 most publicly traded companies, including the highest growth tech stocks that have been consistently booming, so why wouldn't you invest in it? But many forget to see the downsides, and more recently it got me thinking whether right now is even a good time to start, or even keep on investing in this ETF. With countless headlines of job loss, rising unemployment, increasing inflation with possible rate cuts, the entire US market really is propped up by the AI surge in speculation. Even with all the bad news and indicators pointing towards a possible recession, the market seemingly never fails to set new all-time highs at an exponential rate, until now. Just recently, with Nvidia's earnings report beating expectations, it skyrocketed the entire market upwards after a considerable bearish downtrend. Then, less than 24 hours later, all of that money was taken out of the market, resulting in a massive 1.5% drop due to AI speculation and overvaluation concerns. For something that's supposed to be a safe investment, it experiences such high volatility, which is not necessarily the smartest thing to invest into when trying to grow your money long term. These companies being invested into the S&P currently all generally rely on Nvidia to continue to lead the charge on the AI market and keep the market propped up and pumping. Actually, except for Google as of recently, which seems to be acting a little more independently. What was once a diversified index fund that has general steady growth has turned into high volatility that focuses on the biggest AI tech stocks. These stocks make up roughly 35% of the fund, and yet you would generally earn a bigger return than the S&P if you actually just invested in the Magnificent 7 since the beginning of the year. The S&P year to date has seen about a 14% gain, while diversifying equally in the Magnificent 7 would have seen roughly a 19% gain year to date as of the timing of this recording. With current high volatility and uncertainty in the economy, nobody really does know what holds for the future of the market and the economy as fear increases. The safest strategy is to generally dollar cost average and buy no matter what the price is, which is generally correct. But with the current overinflated valuations of these stocks, it's hard to justify buying in at these crazy all-time high prices without considering the potential risk. Timing is the most difficult, but keep in mind the stock market does not go up forever. Prices will have to come down eventually, and with cracks already showing with confidence slowly being lost as well as fear increasing, I have a feeling it could be soon, like sometime in the middle of 2026. All I've ever heard these past years is that SPY nets about 100% return every 5 years, but that's not always the case. There have been times in American history of economic downturn that have lasted for prolonged periods of time. The last economic downturn was in 2022, where we were in a year-long bear market. In times of uncertainty such as the dot-com bubble and the 2008 financial crisis, the market was relatively stagnant. Say, for example, if you started investing in SPY in 1997 at a price of about $900 and never pulled out your money, you would finally see actual growth 12 years later in 2009, where it would reach past $900 and finally continue on a further uptrend without crashing back down. Most people invest into SPY and never pull out until retirement, but when investing in times of high uncertainty and bubbles, a rapid growth similar to the dot-com bubble tends to show we could be heading towards a bear market, resulting in potentially a 40% loss in investing growth if buying at the peak. Realistically, it most likely won't fall as drastically as the dot-com bubble, but contributing to a long-term investment at a time like this can be risky. My worry now lies with this rapid AI growth. SPY has been advertised as safe and a good investment, but I think the market has to correct itself eventually, and nobody can predict when this will all fall, but investing in your future at the peak of this rapid growth is worrying and in my opinion not safe. With all the factors in this current economy, it is extremely difficult to justify these prices and valuations while the average person is struggling more than ever to get through their day-to-day lives. Now you might ask yourself what to invest in if not the S&P, and most people would consider gold. At the time of this recording, spot gold prices are continuing to rise past $4,000 and seem like they will continue to go up. Theoretically, market growth and gold growth should inversely grow, but they are both trending in the same direction and at a fast rate. It's a time of rapid market growth, which should indicate a strong economy, but we are an AI growth economy, which is being held up by investor speculation and the highest income earners. Gold growing the way it is not a good indicator by itself and is experiencing the same type of volatility as the S&P, if not more. Nothing really feels like a safe and stable investment right now, and it's a really difficult position to be in if your entire savings is tied up in the S&P. Nobody can guarantee positive returns on any stock. They're just basing it off of the past historical data. The safest form of investment you can really make is in bonds and high yield savings accounts. which will not net you as high of a return as S&P, but you would not have to worry about the market crashing and losing a majority of your capital. The only way you could really lose money with these safer investments is practically if the American government fails to make their payments on debt, which would be an entirely different issue at that point where the whole country would be in an economic crisis. All this to say that none of this is financial advice and just my personal observation, but let me know what you guys think about this and if your thoughts of index funds have changed in this current economy. If you can also please like and subscribe if you enjoy this type of content and would like to see it more in the future. Thank you for watching.